All right, so good morning, everyone, and welcome to the Macro Snapshot. We are Wednesday, July the 2nd, 2025, recording this in the morning as always. Okay, so let's just see what's going on. Not a huge amount of news flow or anything, but what is interesting as we go into the second half of the year is just that the market is trying to understand, is the economy strong enough to weather any potential tariffs? And therefore, and also what is the situation with with inflation? So the data is very, very important because essentially we had Powell yesterday just on a panel with other central bank leaders in over in Sintra in Portugal, and he essentially said in not as many words, but basically, were it not for the tariffs, probably the Fed would have cut at this point or would have begun their cutting cycle. But he said that the fact that there are tariffs, inflation is still relatively sticky, the economy is still strong, and therefore he's in no hurry to cut. So it's the same old thing. Obviously, on the other hand, President Trump is pounding him and demanding cuts. But Powell seems to be very much sort of in the camp that nope. He's still a bit worried that inflation might be caused by tariffs. They'll need another 2 or 3 months data, and that's the situation. And also, just sort of politically, it was interesting that just on that panel yesterday with Lagarde and Bailey and Ueda and the head of the Bank of Korea as well, they all sort of unanimously sort of made it very clear that they were not going to be sort of subject to political pressures, at least in public. So Powell seems to be holding the line, and therefore, sort of data is very, very important. So let's just review the data. So yesterday, I would say the data was mixed, although the market took it yesterday in a positive sense. And I understand that. I mean, basically, if you look at the JOLTS number, which is the jobs opening here, you see that that was higher than expected. So instead of expectations of 7.3 million, came in at about 7.7 million, which actually was 400,000 more jobs than last month. So you have to say that is definitely strong. The job openings level came in at 4.6 compared to 4.4. So that is a higher number of job openings. The quits rate was up. So that means more people quit. And as we like to say, ordinarily, that's a sign of a strong sort of labor market where people have the confidence to quit because they assume they will get another job relatively quickly. And they also assume, I imagine, that other job will pay more. So that is, again, a positive number. The quits rate, as you see, in percentage terms, was up a little bit. And the layoff level actually was was lower. You see the number here was lower than expectations and lower than last time. So you've got to say at this point, that's all pretty good. On the other hand, the other data is construction spending, which was negative 0.3, which was worse than last time and worse than expectations. And I looked into some of the details of that, which I won't go through. But basically, there's not a lot of money happening in construction. It's really slowing down a lot. So that would seem to indicate a slowing economy or less demand. And ultimately, for the labor market, that in theory should be a negative thing. Then if we look at the ISM, we do get this sort of stagflationary sort of profile again. So if you look at the employment numbers, you look at that, the employment numbers there, 45 compared to 46.8 last time and lower than expectations. So employment expectations there, excuse me, are going down. New orders was also going down. So 46 compared to 47.6 last time. So that's also going down. The overall number, though, was a little higher. But look at this prices paid number. The prices paid number continues to be very, very sticky. So it does seem to me, I mean, so I would say relatively contradictory sort of data. But you could say that, the JOLTS number is, apparently, I mean, it's a complex number, but apparently it's the number of jobs which are being sort of posted. And that was pretty positive. And so the market took that in a positive way. And we actually can see here, if we just look at where we've got here, just where we're at with the interest rate situation here. So you can see here that for December, just looking at the price action, this has been essentially for the last few days. If we just scroll back, remember each sort of section here represents 1 day. So if we scroll back here, 5 or 6 days, we can see that we had gone from about 46 basis points of cuts by the end of this year. That went all the way down almost to 70 basis points of cuts. So that's about a full extra cut there was priced in, about 25 basis points. But you can see yesterday, once we got that data, that the market decided that was really a little bit too dovish. And we essentially the market took out from 69 basis points down to 63. So it took out about 6 basis points of cuts. So this still represents over 2 cuts. If we look here, just in kind of the tabular form here, we see we have 2.5 cuts still priced by the end of the year. And as we just saw in the other chart there, 63 basis points. So that's where the market is at the moment. That still, on reflection is a little more dovish than it was, let's say, a couple of weeks ago. If you remember, we were below 50 basis points for about 1.8 cuts or so. What is interesting as well is the pricing for the upcoming July meeting, which is at the 30th of July. So at the end of this month, so still about 4 weeks away or so. We've only got 4 basis points of cuts priced into that, which represents approximately a 20% chance of a cut. So at this point, the market is saying, well, basically agreeing with Powell and not with sort of Trump in a sense, and saying that the data at this point indicates a relatively strong labor market. It continues to indicate, as we saw yesterday with the ISM prices paid up at 69, that inflation is still relatively sticky. Let's see what the market is thinking about that, the inflation expectations, because that is kind of interesting. Just give me a second here. I'll go into it and find the inflation expectations. So this is inflation swaps, which is what market participants believe should be the situation. Let's have a look here. Inflation swaps. So trying to just understand here if the market believes inflation is just stable or potentially going up. And if we go here, we have all the different tenors. So this is going from the shortest term one, which is 1 year. So 1 year out, you can see that the market is still expecting inflation to be at about 3.1%. So still pretty sticky. Now, obviously, the further out the tenors we go, so the blue, you've got the 2, and then the 3, and going all the way out to, let's say, the 10 down here in the orange down at 2.5, and all the way out to 30 down at 2.4. So at the longer end of the curve, still relatively sort of flat, but definitely is ticking up a little bit, although it depends which way you slice and dice, because one could argue that the high here recently at 3.6 of the 1 year inflation swap was at the beginning of April, just after the tariffs. So essentially what's happened is that once Trump announced the tariffs on Liberation Day, which I think was the 2nd of April from memory, of course, there was this idea of sort of inflationary pressures would be coming through. And that's slowly ticked down. So we've gone from a peak of 3.6 down to 3.1. So you could argue that the market is a little more sanguine about sort of inflation, at least over the next year or so. And it's certainly at the long end of the curve in terms of inflation swaps that has sort of stabilized. But the point is that this is not, near the Fed's target of, 2.2 or 2.3 or something. It's not down at 2%. So yes, it's come down. There's a little less stress or concern about the inflationary effects of tariffs. But again, we don't know really what's going to happen with the tariffs. And that's all that's Trump, that's all that Powell is saying. Yesterday in his comments, which I listened to, he was essentially also being a bit agnostic. He said, listen, his base belief, or not even his base belief, but most professional forecasters believe that inflation will tick up a little bit, over the next 2, 3, 4 months. But he basically said that if the data weren't to show that, so if inflation actually stabilized or even went down towards their target, he would start cutting rates at the end of, towards the end of the year. So I think he's slowly trying to give himself sort of a window of justification so that when it comes for the Fed cutting rates, probably like September, October situation, he won't look like a sort of a patsy or a sort of the little puppet of Trump. And he basically wants to point to the data and say, hey, I waited for the data. The data now gives me justification to cut rates. So let's have a look and see what's going on. Now, just in terms of tariffs, we haven't really had any more sort of deals announced. Trump, of course, is always saying that, stuff's happening any minute. But it was interesting. I've just got a quote here from the Japanese sort of trade negotiator, a certain Mr. Akazawa. And he basically said, this is a quote, agreement that would hurt Japan's national interest for the sake of timing should not be made. And we know that Trump, is saying that, he wants everything done by, July the 9th. But the Japanese, trade negotiator here, Akazawa, is basically saying we don't want to harm our agricultural sector. We don't want to do anything which is not in the national interest. We're going to take our time and try and figure out a deal which is acceptable and amenable to the Japanese. And I think that at this point, this is the case with, I think, also the Europeans. I think it's also the case with the Chinese. We haven't heard about those trade negotiations for, several weeks, it seems. So I think at this point, the negotiations are going to just grind on probably for another few months. Trump will, of course, attempt to get political capital from them, but I just don't see that happening. So I think the focus will be back on the data, the real economy. We have earnings starting to happen over the next few weeks, and let's see what happens there. So just quickly, just looking at the data for today, we just got a little bit of data coming in. So We have the ADP numbers coming up in about half an hour. Let's have a look. That's forecast to be 98,000. Remember last time that was only 37. So it was 98,000 forecast, which is on the low side. We've also had the challenger numbers here. So let's just have a look at the challenger numbers. I just looked at those from like 10 minutes ago, and I just did a quick sort of a screenshot here. So what we can see here, US-based employers announced, let's call it 50,000 job cuts for the month of June. This is this year. Now, compared to the same month last year, the job cuts were down 2%. So you could say that that's technically kind of good news. So less job cuts. This brings the total number of layoffs in the second quarter to 250,000 job cuts. This is this year. That is up almost 40% from the 177,000 job cuts in Q2 last year and the highest Q2 total since 2020. So if you just go month over month, or the year-over-year monthly sort of comparison, it looks okay. But if you actually look at it in terms of the quarter, this is shaping up to be, as they say, like the worst Q2 since 2020, which obviously is COVID. And even if you compare it to last year, Q2, we're up to 250,000 jobs compared to 180,000 jobs, job layoffs, so cuts. So that I would say at the margin is looking a little bit negative. Okay, so let's just have a quick look at a few charts here and see what's going on. So let's start here with the yields. You can see here on the 1 year yield. So this is a yield chart on the daily. So you see here just for the 1 year, just ticking up a little bit. But really where you saw it yesterday and even today, you see that this front, which had been repriced pretty dovishly, you can see that from yesterday and today, the 2 year has been repriced sort of fairly hawkishly based on that sort of data yesterday. Also, I think based on the fact that Powell made it clear yet again, that he's going to be data dependent and was in no hurry to cut rates. So I think the market is just pushing back a little bit and just probably repricing. I don't think this is going to rip, all the way up to 420 or something like that. But, it could if we get the data today, but especially tomorrow, we get a lot more data. And obviously we get the payrolls number tomorrow. For sure, that could pop up to, maybe 390, 395 if the data remains hot. But you see here, it's really at the front of the curve. So the 2s to 5, and you see you go out to the 10s. But if you go out to the 30s here, well, it's gone up today, but not quite as much as yesterday overall. So overall, the sort of the curve, the yields are going up. Now, would that sort of lead to a bit of US sort of dollar strength? The dollar, if we just look at the chart here, it found a little bit of support. It found support at the top of the trading range. So you see this, this pink line here, about 96.7. It goes back to the top of the old trading range. So found a little bit of support there. So, do we get excited about this? This is a little bounce of, I don't know, 50 basis points or something, 38 basis points. There you go. The moving averages are still all pointing downwards, still pretty weak price action here. Again, nothing really to say that, US data is strong or that the administration is, particularly sort of in control. Although what we did get yesterday is that the one big beautiful bill, so this whole bill, which is going to extend tax cuts and offers a little bit more of deficit spending. So you could argue that that is, mildly expansionary or at least or stimulatory, but at least it's not a sort of the opposite. It's not any form of austerity. That also contributed yesterday to a little bit of positivity, probably in the US dollar, just sort of stabilizing. And also, as we saw, just the front end of the curve coming down and the bonds coming down a little bit. So if we look here at the VIX, volatility very flat here. You see pretty flat. If we look at the volatility of VIX, that's also at a very sort of flat level here. So looking at here, the equities is an interesting one. As I said, the earnings season will start, sort of kick off, in a couple of weeks or so, 2 to 3 weeks. Just seems to be running out of energy here. Again, this chart has done absolutely nothing wrong. It's had a huge run up since, well, we all know what happened after the tariff announcement, and then it, did a V-shaped kind of bounce. So a very strong chart. All of the moving averages are pointing upwards. It's a little bit oversold. You could argue here as I was saying yesterday, some of these Fibonacci extensions, we're getting towards some of those. But I don't know if this is going to be collapsing in any shape. It might just be sort of taking a little bit of a sideways pause and maybe just waiting for the data. Let's see. The other issue as well is that the one big beautiful bill, which as we know is Trump's whole program, that has now been passed by the Senate. and is now going to the House of Representatives. Now, there could be sort of, some problems there. There could be some changes made, some amendments, in which case it would have to then go back to the Senate to be voted upon again. On the other hand, it may pass the House of Representatives. And at that point, you'd have to say that would be some kind of win for Trump. And that would take away one sort of aspect of uncertainty from the equity market or the broader markets. And maybe that's what the markets need to go a bit higher. One thing which is interesting yesterday, you see here the Nasdaq coming off, but what we have seen over the last couple of days is that the Russell has actually been sort of outperforming a little bit and seems to finally have broken above this sort of Fibonacci retracement and pretty key sort of level here. So you see here the Russell definitely has been underperforming for the last sort of 6 weeks or so, but it's starting to push higher. And we also see that if we look at the equal weight ETF here, the RSP, you see that had a big sort of a breakout candle yesterday. So it looks as though there was a bit of rotation happening yesterday. Maybe Trump's bill being passed by the Senate was sort of a positive, much more for the domestic, the smaller cap companies. So we saw yesterday, as I say, the equal weight doing pretty well, and also the Russell. So let's see if that continues. And you can compare that here to the Mag 7. So you see the Mag 7 yesterday actually down, and you see the equal weight and smaller caps doing much better. So I think there was probably just a little bit of sort of sector rotation there. In terms of other things, just finally want to have a quick look at oil here. Oil's interesting. It has been in this range. We remember all the shenanigans with Iran and Israel, and has been in a sideways consolidation. Is this a bit of a push out? You have to say here, I don't know. I'm not seeing a specific catalyst. Again, if one were here to sort of write headlines, we could say that, Trump's bill passing and et cetera, et cetera. I don't see that there's anything has particularly changed in the last 24 hours about the oil market. I see no reason, though, why it can't pop a little bit higher. The market is still quite short from a positioning point of view. We have some moving averages here. We have the 100-day moving average, and having all kind of congregating. So can it sort of push out of that zone? Yes. Will this be a sustained push up? I don't know. It's difficult to say. What we can do, I can look at the curve, which I've got here. Let's just have a quick look at the oil curve, the WTI curve. Which is, I do believe I put that here. Yeah. So you can see here the live data is the white line. So the point is this is compared to yesterday, which is the blue. So yeah, sure, the outright prices are doing well. But what also is quite interesting, I will say, sorry, that's from 1 week ago, the blue one I put up there. What is interesting is that the shape of the curve is still is a fairly strong sort of backwardation. So you can see it's still a steep backwardation. The front end of the curve is trading at a higher premium to the contracts for later delivery. So that is positive. I have to say that is definitely a positive. So at this point, maybe oil, maybe the physical market is relatively sort of tight. We know that there's been quite a strong sort of driving season in the US. There's been a lot of demand apparently for gasoline, so that's a positive. So just getting back to that chart, it is possible here that oil maybe wants to break out sort of out of this little sideways, sort of 5 or 6 day range. And if that's the case, for sure, some kind of Fibonacci retracement, maybe up to the 200-day moving average, 68, or even back up to retest these levels into the 70s. It's possible. Personally, I think oil would be better value in the early 60s, around about here. I was thinking of dipping the toe in, but for sure that does start to look as though it's building a little bit of a basing formation there, sideways consolidation, and even a little bit bullish. We shall see. And again, maybe the data tomorrow, if the data is strong, showing that the economy is strong and the labor market is strong, maybe that'll be enough just to push risk assets on a little bit. And also if the House of Representatives can get Trump's one big beautiful bill passed, that could be a bit of a positive for sentiment, which again could push oil up there. Okay, guys, so I'll leave it there for today. Have a great day. Let's keep an eye on the ADP readings at 8:15, and of course any tweets from Trump or maybe some stuff still coming out of the ECB meeting over in Portugal in Sintra. Thank you. Have a great day.